We're going to go ahead and get started. So I'd like to welcome everybody to my first webinar, first one in 2026. The plan is I want to have these webinars once a month, preferably on the third Thursday of each month, but that will be subject to change based on how the dates fall. But expect a webinar at least once a month going forward. So tonight, we're just going to talk about 2026, getting started with having a financial and insurance review. And I'm just going to go through 3 different areas on what you need to look for on your insurances, your life insurance, your protection insurance, and your investments. All right, so here we go. Okay, so most of you guys know me, retired Army Colonel with 35 years military service. Served in one of the wars physically, was in Desert Storm, participated in Iraqi freedom and Afghanistan stateside as a logistics officer. I didn't go over there, but stayed in the war effort from 2003 to 2014. And in 2014, got my licenses, started my insurance business here in Marysville, and have been in business for the last 12 years now. With that being said, focus on integrity and serving my clients with discipline and making sure it's about you. It's not about what I want, but what you want, what you're trying to get, and helping you out with your insurance and financial needs. Okay, why the reset matters? Well, many people review their finances randomly. This reset ensures you review based on exposure, impact, and efficiency. This is going to be food for thought tonight. Just some things I'm going to throw at you that you probably haven't thought about ever, or probably just now coming to you as we go through these slides. Okay, so who needs a reset? We'll say everybody needs a reset, but particularly working in young families, business owners, pre-retirees, and retirees. Because this is the crawl, walk, run phase of this where you need to get started. You need to build a base to be able to have money all the way through your life. That's what we're focusing on, extending our finances as much as we can. All right, so our objectives today: master the order of how to do a review, things to think about in a review, identify gaps, and assess the impact of how inflation and lifestyle changes your risk. Okay, so clarity over complexity. In 2026, the goal isn't to start over, but to realign. And the bottom line is, if you read this, I want you to focus in on what works for you, because what works for you is probably not going to work for somebody else. You have unique life situations that only apply to you. Now, it may be similar to some, but like I said, really apply to you and how you want to tackle it going forward. And that's some of the things we're going to get into. We got the 3 tiers we're going to look at. Survival, which is life insurance, protecting your income. The tier 2 is security. We're mandated by law, we have to have auto insurance. And most of us have a home. If we have a roof over our heads, that's something that we need to protect. And then that leads over to growth. And that growth is growing our assets for the future so we can have a continuous flow of income as long as we live. Okay, so tier 1, the foundation. We think about these things somewhat. I don't think we really never explore disability. There's a 30% chance that you will be disabled at some point in your work life, where individual disability insurance would be vital. We never know about a critical illness. We want to look at having a comprehensive life insurance policy that can protect us and our families. Okay, so scaling for 2026. You need to think about your salary. You need to at least have 10 to 15 times your salary when you're thinking about life insurance. And I know how that will go into price, but you really need to focus in on that. So for example, if you make $100,000 a year, then you need to think about 10 years down the road. If something happens to you, can you make it where your family can survive for 10 years with your salary still in place, or 15 years with your salary being in place? Or let's say you have a child that's 6 years old, when you know 12 years from now, they're going to be graduating high school. Or when you think about the next 16 years of them having to go to college. These are the things that you start thinking about up front. Limited pay life insurance. I think this is one of the kept secrets in the life insurance industry. What limited pay means is that you can pay this off within your lifetime. It's not like whole life where you're going to pay it for the rest of your life. You could be 120 years old and you're still paying for your whole life. Limited pay life insurance is a godsend where you can set the parameters to pay it for 10 years. You can pay it for 20 years. You can pay it up to 30 years. And it's almost like having a term insurance policy on the whole life side. And this policy is good for kids. We'll go back to the 6-year-old again. If you got a 10 pay, their whole life policy be paid off at 16 years old. And guess what? They have it for the rest of their life. So whoever they marry or whatever the case may be, they have a life insurance policy. This is great for anybody 45 and younger. This is a policy that I would definitely push, especially you're young enough where the rates are very affordable for a permanent policy, which is the same thing as their whole life. But at the same time, you're going to finish paying it off. And then you also have wanted limited pay up to age 65. So that way you can pay it up to age 65 and start, guess what? Withdrawing the funds tax-free. That is the beauty of life insurance. But to this slide, we want to start early. And I want to touch on term life, but term life is, at the end of the day, is cheap, it's affordable. It's probably the first thing you can get into, especially for young adults and teens that are eligible for term life that can actually earn an income. Moving on to later in life. Now we're looking at whole life insurance, but I draw your attention to the highlighted portion of term life for final expenses. A lot of times, here's what happens. We wait too long. That's what happens. We wait too long, and I get a call from somebody 65 or 70 saying, hey, can I get life insurance? What I have to say is, well, yes, but the deal is now you're paying $200, $300, $400 a month for life insurance. When in turn, if you're looking for a policy, it might be more advantageous just to save that money. But a lot of people come to me late looking for life insurance. And I would say if you're looking at final expense, you really need to look at final expense in your 50s. Or if you want a whole life component, I would say universal life is a good fallback. That way you kind of get the best of both worlds. You get the convenience of a whole life policy. At the same time, it doesn't always last your whole life. It may take you up to 90 years old or 95 years old that you might want to think about in that regard. I'm just trying to give you an idea for strategy, but at the same time, these are things you should be looking at and asking questions when you're having insurance review. Now, as a bonus for life insurance, here's some life insurance tools that you can use if you're really into the investment portion. We have Index Universal Life. Index Universal Life works off of the S&P 500. It works off the indexes and the Russell 2000. And there's a ceiling and a floor. And if the ceiling is 12% and the floor is 0, the way it works, you either could make as much as 12%, but you lose nothing. And depending on what the index does, if the index exceeds the 12%, you're still going to get the 12%. That is your ceiling. But the cool part is you don't lose any money in an index universal life policy. The variable universal life policy is different because that's a securities policy. So yes, this is the most riskiest one because it is linked to a security. It has sub-accounts in it. You can make infinite amount, 32%. You can make negative 32%. There is no floor or ceiling to this one. It's the most riskiest. However, the one with the most growth. People who use it, they'll leverage through their children. They'll get a variable universal life insurance policy through their children because they're young and can give it quite a bit of money and actually use it for themselves because the parents own it. Since they own the policy, it's really their money until they decide to pass it over to the child. The child or the parent could use that money in retirement or for retirement later on. Why is this so attractive? Because first of all, you have the potential as a security. Can't say it's guaranteed, but you have the potential for unlimited growth. And at the same time, once you withdraw the money, it's a tax-free withdrawal. And RILA is a securities product as well, and it uses life insurance and annuities as its basis for investing. All right, so let's move over to tier 2, security and asset protection. Okay, so we're going to focus on these 3 highlighted areas here: home valuation alignment, personal property coverage, and high limit auto liability. Replacement cost versus market value. All right, so what's happened here in the insurance world is the market value or the retail cost has started to climb above the cost of actually rebuilding a home. That is not how it's supposed to work, but that's how it's working nowadays. So what we have to do as insurance agent, we have to add extended replacement coverage just to make sure we can meet the loan amount, especially if the loan amount exceeds the rebuild cost, which, like I said, again, that's not the norm, but that is what's happening now in the market with the prices being the way they are. What we need to worry about is you as a homeowner, you need to make sure this gap is covered. You need to make sure that you have enough money to rebuild your home when you sit down and have your review. If you misalign your coverages, I highlighted here at the bottom, based on outdated estimate, inflated market prices, or incorrect square footage, it can cause you to have shortfalls or gap in your home valuation. Now, the problem is that when I get clients that call me up wanting home insurance, whether they're buying a home or they own their home, they don't know the square footage of their home. They don't know what year the home was built. As realtors, I would ask that you say, look, when you call your insurance guy, hey, let's know the specs of the home. And for me, with my clients, I try to tell them, hey, here's the specs. Let's make sure You know them, I know them. That way it works out a lot smoother. So we can actually gauge where your house needs to be. So why misalignment is risky? Because if you underinsure your house, I have it here highlighted. If you underinsure the home, you won't have enough money to rebuild it. So that's something that's very, very important, especially in this next slide we're going to get to, which is the growth and replacement cost. Now, here in the last 6 years, cost of materials have gone up and the tariffs did not help that any. This is where we're standing right now as far as the cost of materials and what exposures are out there for you. So you have to look at, okay, what is it going to cost to rebuild my home? Let's make sure that we have enough money built in so there are no gaps. All right, here's the next slide. Personal property protections. We're still staying with your home. Anything you put in the home, that's your personal property. You need to make sure you're covering precious items like your jewelry, your fine china. That's what actually gets missed on reviews. I had a client, true story, $20,000 ring. It wasn't appraised. It wasn't scheduled. It wasn't even unscheduled. And the money that he could get for the ring was $1,500 based on the general coverage. So it's important that you appraise your personal property correctly. It's important that if you have jewelry, you go get it appraised, you turn that into me and I'll upload it, and that will have that in case you do lose a ring, you do lose any type of necklace, jewelry, fine china, etc. And make sure you take inventory. A lot of times you don't remember everything you have. How can you? So with cell phones today, you can go around your house and film of everything you have in it. And also you can just go and write down things that you think that are very important. I can upload that inventory list to your policy. You'll cover yourself if something happens. Now we're going to move over to auto liability. We're mandated to have auto insurance, but a lot of times I see people going for the minimum amount of liability coverage, which for Ohio is $2,550. $25,000 per person, $50,000 for the total incident. And guess what? The ambulance ride to the hospital is $25,000 in the emergency room visit. So we need to think about, do you have enough liability limits? Is your liability limit high enough? Because medical bills can exceed your limits quickly. And at the end of the day, it's going to expose you to out-of-pocket expense and lawsuits. Just think about that when you go to have your review. Make sure you're comfortable with your auto liability limits. And also make sure you look at the underinsured and uninsured portion of that too. The worst part is you normally get hit by somebody who probably doesn't have insurance or have enough insurance. So you need to have that insurance to protect you from the next man or the other man. All right, so to wrap this section up, you can look at an umbrella. And an umbrella is basically liability insurance that goes on top of your home and auto limits. Now, to do so, you need to have limits that qualify you for an umbrella. That qualification may be to have 100,000, 300,000 for auto, or even 250 to 500 for auto to qualify for an umbrella. But it's worth it if you feel like you have assets you need to protect. And right down at the bottom, teenagers or young adult children that are still on your policy. Because we look at it like this. Let's say you're a teenager or your adult child has an accident and they're on your policy and they make someone a paraplegic. Well, guess what? You're going to already exhaust that $300K or that $500K. You're going to exhaust that easily. That $1 million of umbrella is going to come in handy. As soon as your limits are exhausted, the umbrella would kick in. But like I said, if you have high net worth assets that you built over your lifetime and you have teenage drivers, or you just have assets that you want to protect, this is something that you need to think about. And the umbrella kind of brings it home as far as protection is concerned. So when you do your review, most people focus on protection first, which is basically home and auto. You need to focus on survival first. Focus on your life insurance, making sure you have set in place some safeguards for your family. The home and auto is going to be there. It's not going anywhere. As long as you have a home, as long as you have an auto, it's not going anywhere. But life insurance, you need to make sure you get that going. Tier 1, that's why we put it first. And the lowest premiums, look, price over terms, lowest premium is not always the best. I have people look for price and I have people look for coverage. And I have people who don't care about the price because they want the coverage. And I have some people that care about nothing but the price and not the coverage. So you got to do what's best for you, but at the same time, don't go in with the mindset of, I just want the cheapest. Make sure you can get the best for less. How about that? Get the best for less. That's the best way I can put it. Static review. So remember your grandmother sending you to the store with $5 and the next thing you know, you're like, Grandma, that's not enough money. but she's still thinking it's back in the day. So the same thing with your insurance. Don't think that 2021 prices are still holding up today in 2026 with the way inflation is going. Tier 3, kind of talk about making sure your money lasts a lifetime. And I know this is about review, but when you review, you need to go in with the mindset, how does my money last for the rest of my life? Most people are living 15, 20 to 25 years past retirement easily. As we get more educated, as we eat better, we think about our quality of life, these things come into play because what you don't want to have is more life than money in your pocket. These are things we're going to look at here. For those, I don't know if anybody here is getting ready to take out their 401k on the RMD, the required minimum distribution. But I want to talk about that too, because that's something that if you know somebody that's getting to that point, I'm going to touch on some things you need to think about. Protection before growth. Well, we got the protection in place. Again, you got to think about longevity risk. If you live too long, you want to secure the floor to be able to reach the ceiling. And those of you that are getting ready to retire, football phrase, you get in the red zone, where the red zone for retirement is 5 years. So you need to start really thinking about where you are before you get to the red zone and where you want to be when you get to the red zone and how to build your plan basically coming up to the red zone. You have rollovers. Okay, so your 401ks. I want you to think about this. If you're changing jobs, if you're looking to diversify, think about and I think I'm going to go back one. I think there was a spot there. Okay, so consolidate, optimize old retirement accounts from the rollovers, but I'm going to go back up, not to confuse you. But what I want to get at is once you get over 59 and a half, what can you do with your 401k? Are you going to be able to withdraw some of the money, move it over to some other investments, i.e. any annuities or any type of mutual funds or any other investment vehicles that you want to work with? So once you get to 59 and a half, you really just need to start thinking about what can you do with your 401k if you want to diversify it a little bit more. Now, we're going to talk about RMD. At some point, your 401k will have to be taxed. You've been living tax-free, basically rent-free for all this time while it accumulates. And you see all this money in your 401k, you're looking at it, your eyes are glowing, you say, oh, this is great. But at the same time, the tax man has got to get his portion at some point. So RMD is designed for when you turn 73 years old, and they've extended it. Here's a kicker. Can you live that long? Will you live that long? You need to consider maybe a Roth conversion. Go ahead and give them being the government, give them that money, let them tax it, do the Roth conversion. Now, anything you make, all your gains now are tax-free. And when you pull that income, it's a tax-free income pool. And it also saves the tax burdens on your beneficiaries. So if you have your kids and you don't want them to have that tax burden when you pass away with your 401k, hey, this is the way to do it because the tax man is going to get his money. So Roth conversion is one avenue to look at. And then also the second avenue is QLAC, Qualified Longevity Annuity Contract. We can help you take your minimum distributions, but we can soften the tax blow where you just take out so much without taking a big tax hit. But I just wanted to touch on those things. So the goal is continuous income, not outliving your income. There used to be a time when it was talked about more money, more money, more money. Just keep making money. Make all the money you can. Stack all your chips for life. But what we found out is one health incident will wipe out a 401k. And when we break it down, 9% of companies offer a pension today. Those things are out. Social Security was never meant to live on. And right now, statistically, 40% of retirement income is Social Security. And it was actually meant to be about 20%. So it's double where it should be. That leaves that gap. And that gap is where your 401k and annuities comes into play and your investments. So you really need to think about how you're going to manage your money in order that you don't outlive it. Things you need to be concerned with. Whatever investment vehicle you're using, make sure it has an inflation adjustment to age of purchasing power. For example, if you had a fixed annuity back in 1969, well, obviously at 4%, that's not going to help you in 2025. You need to have a variable annuity. You need to have something that's going to ride with inflation. You got to also think about your healthcare costs and contingencies. I didn't highlight long-term care, but that's a consideration as well, because right now I think 2.2 years of long-term care for men and 3.7 years for women, if that comes about. That's something you should also be looking at in your 50s, because that's a point where you're probably the most healthiest. and you could probably financially swing it. Okay, so the goal here, the bottom line of this is in your review, you got to work for continuous income. Action matrix, now versus later. So you might want to validate your life insurance. That's great. It talks about review your beneficiaries. I'm going to say always review your beneficiaries. I wouldn't say wait till the quarter, but the book says wait till the quarter, but I would say always review your beneficiaries anytime you think about it, especially if things have changed, and they can change at any time. And this is what I was getting at about the rollover. Make sure you check your rollover eligibility. What can you do? And even if you're not 59 and a half, there's options for you to move that money if you want to. You can move percentages of that money as long as you do not keep the money over 60 days, which will cause a tax event. If you're just rolling it over from one account to another, that is not a taxable event. Here in summary, thank you for your time. I really appreciate it. I will open it up for any questions. I appreciate you guys just building on this. I think this will be good because I just want to educate people. It's really not about selling anything. Whether you work with me or anybody else, you're prepared to have a knowledgeable conversation. I will open it up for any questions, concerns, or comments.
I have a question for you.
Okay.
Do you suggest that when we do these annual reviews that we should include our family members with it as well, so that way they're aware of what our choices and our intentions are?
Make sure somebody knows where to get your paperwork if something happens to you. That's the bigger problem we have in every community, is that something happens to you and nobody knows where your paperwork is. I think it's more important to take somebody you trust there, but at the end of the day, somebody needs to know where to have access to your policies. Any other questions, comments, concerns? Again, appreciate your time, and another topic next month. I did leave my contact information. If you need me, give me a shout. Appreciate your time. Thank you.